You're online, please start.
Hello, everybody. Today we start a keynote of Matthew Merle, managing partner of Fifth Era, Mastering Early Stage Investing. And I introduce you to Matthew. Matthew, please join us.
Good to see you, Nadia. Hope everything's well in your part of the world.
Yes, thank you. And please start your keynote address today, Mastering Early Stage Investing. Thank you.
Very good. Well, firstly, let me say that it's good to be with you all again. I enjoy these sessions with LATOKEN, and obviously our goal in the next few minutes is to share some of the things we've learned about early stage investing and some of the best practices that the leading early stage investors use as they go about backing technology companies. And I'm going to spend a little bit of time sharing material with you. And then I believe Nadia will be posting this so that the material is available online. Just to begin with introductions, this is our team. We've been here in Silicon Valley for 30 years. Alison on the left is my wife and business partner. She was a senior partner of large consulting firms before becoming CFO of BGI BlackRock, which is the world's largest asset management company. And she chairs the advisory board at Blockchain Capital, and is an advisor at Bitwise, and has quite a fintech and blockchain background. For my part, I also started off as a senior partner of large consulting firms before then moving on to be an early stage investor. I began with the Angels here in Silicon Valley, Band of Angels and Keiretsu. We grew Keiretsu to be the most active early stage investing organization, and then we launched our family office, Fifth Era. And blockchain co-investors, we'll talk a little bit about. It's the leading blockchain fund of fund, and that's one of the reasons why I collaborate with LATOKEN, and this is the rest of our team. The insights that I'm going to share with you today are mostly derived from those 15 years investing in Silicon Valley. And Keiretsu, where I am a managing partner, is the most active early stage investor in America and has 55 or so locations around the world. And we see thousands of presentations every year and make about 150 or so investments each year. And then I've mentioned blockchain co-investors. We're investors in 10 of the 16 blockchain unicorns. That's a fund of funds. And that means that we invest in the leading blockchain VCs in Asia, North America, and Europe. So in order to get started, I'm going to share first the playing field, if you will, the traditional perspective. And since I know most of you listening are actually investors yourselves, I think it's important that we set the playing field. So these are the 10 points that I'm going to talk about over the next 40 minutes. The first is, if you're going to be an early stage investor, we believe you have to focus on the exponential technologies, those new innovations that are really changing the world. You have to invest early. I will be showing you some returns data about how the returns begin to fall through the mid and late stage. We think you need to be an early stage investor. We think that for most individuals, your choices are either to be a direct investor, an angel or a family office direct investing into opportunities, or you have to back the venture capital community. These are your two principal strategies, and we'll talk about that. But whichever one you do, you have to stick to the best practices. You have to be highly diversified. You have to seek out the unicorns and figure out how you're going to get a few in your net, because they do drive the returns. You must make sure you're co-investing with the best investors. This is a long-term investment space, so you have to be patient. And then we'll talk a little bit about how funds of funds can play. So this is the traditional perspective on how early stage investing works. There's a series of funding stages, and there are different capital sources at each stage. There is some belief that valuations are increasing over time. And of course, it tends to be true that as companies pass through these stages, they're worth more and more. And there's some belief too that the risk or the failure rate of the companies is declining. Now, I will talk a bit more about this because in fact, the failure rate changes less than one might expect, certainly in the mid-stage, the venture capital mid-stage. But anyhow, so there is this equation, and you as an investor have to decide what is your appetite or your strategy for both risk and for increased value and returns. Now, traditionally, we thought of it in a very simplistic way. Early on, startups can get grants if they have technologies that are viewed as important by governments and companies, but then they'll typically raise their first rounds from friends, family, and the founders themselves. And then at some point, they will meet individual angels, and all the way through the seed and into the early A stage, they'll be getting backed by angel investors and family offices. Venture capitalists will typically get involved in the bridge into the Series A and the Series A, and will take the business from there. In a moment, I'm going to explain that that is actually not exactly how it works, at least in the world in which we inhabit here in America. But I will keep going for the moment and explain that there have been dramatic changes over the last 10 years. So since the great financial crisis of 2008, we saw the largest venture capital firms pull away from formation and seed capital. The best of them raised larger and larger funds, so that we have the Sequoias and the Andreessens and the NEAs with multi-billion-dollar funds. And they began to focus on Series A and later, the mid-stage, making larger investments in ever larger rounds. And that gave rise to the opportunity for micro funds, micro venture capital funds to surface and take over the seed round alongside the angels and the family offices. And the other big theme was corporate venture, where many companies, in fact, hundreds of companies, built their own corporate venture teams as part of their external innovation strategies. Then in the last few years, we also saw the rise of incubators and accelerators, which took over the formation stage. And today, I think it's fair to say that most startups, and certainly first-time entrepreneurial startups, will begin life in an incubator and accelerator. They'll get a lot of support, but it will still be angels that back them. And many of the angels do spend time as mentors and coaches in incubators and accelerators. We also saw the rise of crowdfunding, and this was as a result of the Jobs Act in America and similar initiatives in Europe. And so we saw platforms like AngelList and Seedrs and others get established. And those crowdfunding platforms do provide another source of formation capital, typically relatively small rounds. And so as companies move into the Series A, they still need to find the more traditional ways to raise capital. And then finally, in the late stage, we've seen an increased expansion of ways for companies to raise capital. And whilst we as investors may not participate so much in that space, bank loans, and then all sorts of agreements with larger companies, licensing JVs, partnerships, and established acquisitions, and so on. So this is the space that we'll be talking about, but I will be primarily focusing on the dark blue. Angels, family offices, venture capital will be the focus of the next 35 minutes. Now, the first point we made was that as an investor, you want to seek out teams of people that are really using the world's leading technologies, exponential technologies, to drive their businesses. And this is a remarkable time that we live in. We are in the midst of an unprecedented phase of global innovation, and some of them are depicted here. Artificial intelligence, the Internet of Things, the internet and cybersecurity, of course, the life sciences revolution, the fintech revolution, clean technologies, augmented and artificial and virtual reality, and then, of course, blockchain. And there are others, but the point is that each one of these is a disruptive technology, and taken together, they compound, and they are moving every industry and every geography forward in a fairly dramatic way. Alice and I call this the fifth era, and it's actually what we've named our own firm after. And we've written books on this topic, which I'll talk about at the end. But this is important. Of course, you can be a consumer or a retail investor investing in bricks and mortar and traditional businesses. You can invest into forestry and real estate and other things. But this is what's driving value creation around the world. And I think everyone today is aware that all of the most valuable companies in the world are technology companies. These are the top 5 highest valued companies in the world. Alphabet, Amazon, Apple, Facebook, and Microsoft. They're all based on the West Coast US, and they all use disruptive technologies and the internet specifically to dramatically change industries. I would say that right now, in this time when we are all battened down in 2020 because of the virus that has become a pandemic, each one of these companies is benefiting from the steepening adoption curves of virtual living. So that point of focus on the exponential technologies is also demonstrated in investment returns. So these are the 25-year net IRRs on an annualized basis for a variety of asset classes. And these are the American data. But in terms of government bonds, the government bond index, you will see perhaps a 3% return over the long term. In the same time frame, public equities have shown about a 10 or 11% annualized return. But the blue bars represent venture capital. And the average of the venture capital community is about a 24% net IRR, according to Cambridge Associates. But there's a very big dispersion around that number. And early stage is where the much higher returns have been captured in that 25-year time frame. And this is part of the reason why we say that you should invest early. Now, we can also look at the rankings of the most valuable companies, the richest entrepreneurs and people around the world. And what we'll find is they're dominated by people who in the last 15 and 20 years were either entrepreneurs or investors in early stage technology companies. And so this is our second point. Make sure that you are in the early stages of investing in these technology companies. Now, the third is you have to decide how you want to participate. And this is what I showed you before. This is the conventional way of thinking about early stage technology investing. But in fact, this isn't how it works. And this is very important. The reality is that there are 2 separate funding ecosystems taking place and that they are interacting with each other. The first of them is the angel ecosystem. And here it's still true that startups, about 75,000 technology startups in America every year, will first get their funding from the 3 Fs, friends, family, and founders. However, after that, they will be backed by some angels and perhaps some family offices. And those will be the only investors that ever back them. And the vast majority of those companies, if they do get to a successful exit, it will be a corporate acquisition. And so this ecosystem is building companies to sell to large corporations. And so the goal here is to find a technology and an innovation, find customers who have a challenge or an issue, figure out how to build a business around that with the plan of selling it to a larger company who will then scale it up. And that is where the angels and the family offices play. Now, there is a second ecosystem, which is the venture capital ecosystem. And this is where the venture capitalists are looking for business ideas that can be scaled up into much larger businesses. It turns out that about 90% of the companies that the VCs back will actually already have gone through the angel ecosystem, and they will already have angels backing them. Only about 10% of deals that VCs back are first-time funding rounds where the venture capitalist is the only or the principal investor. As I mentioned, typically the VCs are coming in at the Series A, and there are already angels involved in those companies. Of those deals that do get venture capital backing, in America it's less than 10,000 a year, though most of those are follow-on rounds. Almost all of them will also exit to corporate acquisitions. So the notion of the IPO, the public offering, is very, very rare. And even though there was a lot of hope and expectation that distributed finance and distributed investing, for example, through the ICO boom and bust, would create more public entities or more broadly held entities, the reality is that very few projects and companies get to that type of an exit. And the vast majority still are bought by larger companies. So these are the two ecosystems, and this sets up a choice for you as an investor. Are you going to be a direct investor, in which case you're primarily going to focus on the angel ecosystem? You're going to do your own direct investing in that seed through mid-stage, whether you're an angel or a family office. Or are you going to try and participate in the venture capital ecosystem, in which case for most people, you're going to be a partner, a limited partner in a venture fund. A few of you might be able to create your own venture funds, but that's exceptional. The vast majority of investors, if they want to participate in the venture capital ecosystem, they're going to be an LP in a venture capital fund. Now, what are the expected returns? Well, interestingly enough here, the expected returns are very similar. So if you look at the net IRR over a long-term 25-year period, the venture capitalists have averaged 54%, partially because the internet boom gave their portfolios such an enormous benefit back in the early zeros and the late 1990s. For angels, we don't have 25-year data because the organized angel groups in America, Band of Angels and Keiretsu were the first 20 years ago, or in Europe, where EBAN was only set up in the last 20 years, they have not been tracking data that long. But when we look at the vintage of deals from 2010, we see it's very similar. The venture capitalists are expecting a 20% on average net IRR, and the angels, according to the academic research, get about a 22% net IRR in the same time frame. But the business model is completely different. As I've already intimated, the angels are building companies to sell, and they hope for many small exits, whereas the venture capital ecosystem are building unicorns and they're looking for home runs. And as a result of this, the actual drivers of returns at the bottom are also very different. The angels are getting 10% of their deals 5x and better, which provide the majority of their return, 85%. But the venture capitalists are getting even more skewed towards very large exits, with 7% of their exits being 10x's and better. And for many VCs, their overall return will be driven by, if they've made 30 investments in a fund, perhaps one or two unicorns or close to unicorns in the portfolio that make the returns of the fund. So now the fourth point is, what are the best practices and what should you do? And this page is really created for the angel ecosystem, but I think it's still very true for the venture capital ecosystem too. A lot of academic research has been done around the topic of what do you need to do to get the better returns and to be a top quartile performer. The first is you have to have high quality deal flow. High quality deal flow often means that you know who's bringing it to you, you understand the relationships, and the bad deals are already being flushed out. And for established angel groups like Keiretsu, and I'm sure it's true for LATOKEN too, a large percentage of the deal flow will be coming from people that we already know. The second is you have to have a strong due diligence culture. The academic research shows that when investors spend a lot of time, 40 hours or more, on due diligence, they get a much higher return, a 6x. Whereas if they just invest without doing any due diligence, they get just on average their money back. You have to be very active with the portfolio companies and help them succeed. And many angels and family offices will only invest in companies that they think they can help get to market and scale up. And then deep expertise and tight relationships with follow-on investors are also very important. So these are the best practices. Now, fifth point is to be highly diversified. This is a CB Insights page, and they looked at more than 1,000 venture capital rounds, and they looked at how many rounds did those companies go through before they either had an exit, an M&A exit or an IPO, or conversely, they failed to raise more money, which didn't mean that they went out of business necessarily, but it meant that they moved into a smaller, sustainable scale of company. So you can see of that 1,000, only a handful went all the way through the process and went through multiple funding stages. And in the bottom right-hand corner, you can see the exits. Most of the exits were very small. 40 or so exited over 50 million out of that 1,000. So this is exceptionally a small number. And only 5 of the 1,000 became companies valued at more than $1 billion, unicorns. So 5 out of 1,000, which in this cohort included Stripe and Docker and a few others. So the IPO is very rare. The large exit is quite rare too. And what happens much more frequently is a lot of small exits. But it also implies that since this is a hit-driven business, given the risk-return profile of the portfolio, you want to be highly diversified. You need to make a lot of investments. And if you have a choice, it's better to make a lot of small investments than a few very large investments. Now, when we do look closer at the large exits, the unicorn exits, they are also very, very concentrated. This is data for since 2019, again from CB Insights, and you can see the number of unicorns that were backed in the early stage by different investors. Now, obviously, you can also buy unicorn stock in the late stage in the secondary market, but that's not what this chart is showing. And you'll see the names. Some of them are very early stage. SV Angel, Y Combinator are backing in the formation phase. But otherwise, we're talking about the world's most successful venture capital firms: Sequoia, IDG, Andreessen, New Enterprise Associates, and so on, Kozler Ventures. These are the world's best VCs. In California, in Silicon Valley, we have more than 1,000 VCs, and we estimate that at least 950 of them, 95% of them, have never backed a unicorn. And that's part of the reason why the top quartile results are either typically well-known names or they are first-time funds, which is a particular anomaly that we could talk about at another time. So now, diversification in practice, what does it mean? And what it means is that because of the reliance upon the large exits, you need to have a good number of investments to get the expected return probabilistically of the early stage investing asset class. And Professor Wiltbank, who is a leading professor in this space, estimates that if you have 12 investments, you have a 75% probability of getting that return. By the time you get to 48 investments, you have a 95%. So the point here is that diversification isn't increasing the return per se, but it's reducing the risk that you don't get to the expected return of the asset class. And smart investors manage for risk and return, and therefore they're highly diversified. So if you're thinking about investing into early stage companies, you should make a lot of small bets. The sixth point is to seek out the unicorn coverage. Obviously, we've already demonstrated that the returns are highly skewed and they're highly driven by the large exits. And these are the world's unicorns, about 600 of them as of January of this year. And they're overwhelmingly in either the US or in China. The rest of the world combined has less than 200 of them. And obviously Europe is the leader in the rest of the world. But if you're going to be an early stage tech investor, you probably want to get exposure to North American and Asian deal flow and opportunities, since the majority of unicorns do surface from those continents. Now, my seventh point is that you should co-invest with the best investors. Now, this is more about the venture capital ecosystem, the second ecosystem. But if you were to decide to participate alongside venture capitalists, either by co-investing with them or by being a limited partner in venture capital funds, then you really want to be in the top quartile. And so what this page does is it looks at each of 3 vintages, 1995, 2010, and 2015. It shows you the mean return, which is still good, but then it shows you the upper quartile return via the lower quartile return. And what you'll see is for the older vintages, there is a very large spread. The lower quartile obviously is to be avoided. 8% is not a good return. You could do better in the public market. So risk adjusted, it's not a good return. But the upper quartile is already doing much, much better in the 4th year of operation, in the 2015 vintage, where it's got to a 25% net IRR. And obviously it continues to rise because some of the exits are further ahead. Now, the challenges are it's very difficult to access the top quartile funds, and they have very high minimums. They expect you to invest millions of dollars in order to play. And there is some issues around persistency. Some of the top quartile firms continue to be top quartile firms vintage to vintage, but there is not as much persistency in venture capital as there is in private equity or distressed investing. The 8th is you have to be patient. So again, we're looking here at long-term returns, 25 years, the 5-year returns. And we're looking at them by stage, late stage, the average, the early stage. And what you'll see here is that the late stage return doesn't really differ. It shouldn't, because the companies are so close to their exits. It's about 11 or 12%, which is very similar to the public market return of 10 or 11%. But the early stage return is much higher over the long term, 54%, than over the short term. And the reason for that is that many of the investments are taking a long time to get to their exits, 7, 8, 10 years and more. And so if you're going to be an investor in this space, you need a very long-term mindset. You need to make sure that the structures and the vehicles you're using are also long-term vehicles. And we've already talked about the need for diversification. And you should also dollar cost average against vintages, which means don't invest all your money in 1 year, invest your money over time. So these, again, are best practices. I think the tokenization of assets is changing this a little bit. But in terms of early stage tech investing, this is a key point. Now, I'm beginning to get to the end, so I've only got 2 more points. The first is fund of funds can help, particularly in the second ecosystem, the venture ecosystem. As an investor, you can be a direct investor in the angel ecosystem if you're an angel or a family office, and you can work with people like LaToken and others who have deal flow that they want to show you. But if you're going to enter the venture capital ecosystem, your choices are primarily to be an LP in some venture funds, but the best ones are very hard to access and their minimums are very high in the multiple millions of dollars. Or you can go through a fund-to-fund vehicle, and that's what we do at Blockchain Co-Investors. We have the leading blockchain fund-to-fund, and we're invested in the top 10 blockchain VCs around the world. And that is something that can be very helpful to find out and seek out early stage technology fund of funds. So that brings me to the end. Those were the 9 points. And just to recap, focus on exponential technologies, invest early when the returns are highest, decide whether you're going to be a direct investor, in which case you're going to be an angel or a family office direct investor, or are you going to back venture capital firms and be an LP or a fund of fund investor into venture capital firms. Make sure either way, the best practices are being applied, and we talked about what those were. Also, be highly diversified, seek out the unicorn coverage, which also means invest in North America and Asia, co-invest with the best investors wherever you can, and be very patient. This is long-term investing. And then, as I mentioned, fund of funds can help specifically if you want to be co-investing or investing alongside VCs. I've talked a little bit about our fund. I won't do more about it now. If you do want to learn more, you'd go to blockchaincoinvestors.com. And you can find more about us online. And we're happy to talk to any investors if you sign up. And then we've published 3 books. And the one on the left is available. All of these books are available everywhere: Amazon, Apple, Smashwords, hardback, paperback. But the one on the left summarizes much of the thinking about early stage tech investing, both what it is and what the data say, but also why you might want to be an early stage investor. And so we encourage you to take a look at those books if you want to do your own research. And these are my personal contact details, and I'm always happy to talk to investors who want to learn more about what we do in Silicon Valley. And I'm sure LaToken can also help give you additional resources and advice. So that finishes what I wanted to say, Nadia. So if you don't mind, I'm going to hand back the webinar to you. Thank you so much for being interested enough to sit through this webinar. And thank you, LaToken, for hosting. We always enjoy LaToken events whenever we're with you in Davos, in London, in San Francisco, and so on. Thank you very much.
Thank you so much, Matthew. It was a very in-depth webinar, and they're all very popular on our VC TV. So thank you so much. And I will introduce also my second speaker soon. Imran, are you online with us?
Yes.
Okay. Thank you so much, Matthew. And I will introduce Imran as well. So Imran Sheikh will also share with us his presentation on how customer is the key for every business. Imran, could you please briefly introduce yourself with the presentation?
Sure.
Thank you.
Sure. Let me share my screen. Can you see it?
Yes, sure. Thank you.
Awesome. Yeah, so let me introduce myself a little bit. So my name is Imran Sheikh. For background purposes, so I founded my first company when I was 18, learned how to code. And after that, I've been like busy founding companies. With that being said, I've had a few successes, but also have few failures. In that process, what I've learned is the biggest value as an entrepreneur right now you can extract is how can you focus more and double down on your customers. So right now, I'm actually heading a product at ShareThis. I'm also managing partner at 0 to 1 Partners, which I founded. It's an advisory and angel group. And let's get started. I want to start off firstly with this quote of Steve Jobs, not to make it more cliche, but the fact that how important is the customer. One of the things that I've seen across multiple companies and startups, whether they are even growing or they're small, is their focus on their customer is there, but they're more focused on their competitors. They either focus more on technology. Yes, technology is the means to build a great product, but if your customer is not to the focus of all of it, meaning if you're building, let's say, an app to order a cab like Uber did, right? And so if the whole idea was, oh, how Google Maps would work, how you can estimate the times and the technology is so great and so forth, and they really ignored the customer and that it, Uber wouldn't be where it is today. And that's the most important part that we're going to talk about today is what are some key ways to focus on your customer, which would, and customer in this case could be your user, which would actually help you grow and scale your company. Just a little bit about background about me. As I mentioned, I've founded some companies. I've also had some successes and also failures. I'm heading product at ShareThis. It's one of the largest sharing platform and one of the leaders in ad tech. And I've been doing a lot of speaking engagements also, but I'm also a lot of a keynote when it comes to new startups. And when I was 21, I won this Architect of ID award by ITC in Asia. And yeah. So the experiences that I'm going to go on first is basically based on all of what I've seen, what I've experienced, the failures that I've seen firsthand. and also seen secondhand when I'm helping other entrepreneurs. And one of the things I couldn't highlight more on my screen right now, your user, your customer is first. And the reason of that is to basically have a sustainable and scalable product. You don't want to build a product as an entrepreneur. I've seen so many. So let me give an example. This company, just for sequence purposes, they built this design tool. I don't want to name them, so let's call them Design A company. They built this design tool that actually helps entrepreneurs and coders mostly to extract the design components in an easy way so they can actually code and build a website. The matter of fact, the way I even let you know that how this product works is complicated from where it sounds. They didn't even validate the product. They only talked to the customer, which they thought would be a developer. They didn't cover all the bases of knowing possible users or possible customers for their product. And what I realized over time with them is, they're disconnected from the user. Because the fact was they were more concerned about how they're building this great technology, which would be appreciated by developers, instead of seeing how this great product that they're building, which would extract a design element, for example, a sketch app will have a design component. Let's take, in this case, a call to action, and the ability to extract it into a code, making it easy for developers. That was a product, but the reality was it made it easy for designers to basically change the design on their end and able to put a pull request within their system so the developer can just pull that request on their end and hence basically have it on a production website. And that big disconnect actually caused that company a big delay. When I say a big delay, they were like delayed by like 1.5 years. And me constantly focusing on them and saying, talk to your customers, look at your designer customers, because it looks like the feedback that you're getting is the users who love the most, is the designers love your tool. And that is something I've seen multiple. There's one example. There are plenty of those examples. I've been one of those people who have actually built a product, but not understanding who would be the customer, or who am I really building it for? Am I building it for technology because it's cool, or it's really solving a need or a problem? And this is a really common problem. Like, I want to say it out loud. Don't be embarrassed if you have failed. Don't be embarrassed if you got it wrong the first time, because there is no such thing building a perfect product. If there was, there will be tons of millions of companies worth billions of dollars right now. But the reality is, as even you probably saw in Matthew's keynote, there are only few of them who actually make up to the top. And I want to highlight a few companies here. I want to highlight Slack. Slack wasn't a tool for communication. Actually, it was the first product that Stuart, the founder, founded as a product called Glitch, and it was basically a gaming product. And that's where Slack was born. It was a pivot of that game extension that they realized, hey, we can build a better chat system that could actually be more resourceful for workplaces. And did you think that happened because it was just a light bulb head? No, the light didn't go up on his head, but it was basically him realizing, seeing the metrics, seeing what the customer is doing, realizing that the chat feature is much more useful. Same with Yelp. Yelp was basically an automated system when it first launched and raised $1 million, and actually raised it almost those $1 million. And they realized they built this automated system of recommending, like friends can recommend each other restaurants. And for shenanigans, they just saw that all of the users, when they saw the metrics, when they tried to connect with the customers, they saw they are focused on reviewing restaurants, location, places. And that was the moment when Yelp decided, let's become a review recommendation company for all of these restaurants and places. Same with Groupon. same situation. They were not a place when they start off to be where you can find these Groupons that people can buy. It was a charity cause that people can come together for and pool in the money to accomplish a goal. And they extended their line of business if they can accomplish that based on what they saw in their metrics. And boom, there you go. And so forth, all these companies that I have logo of, and I'm sure that many of them I'm aware of, but the lack of my screen, I can only fit those many. But it's the point that I'm saying is, you want to be, as an entrepreneur, as a startup, or if you're a Series B or D company, you will have these moments of pivoting and the moments of adaptability, especially in these Corona times. Right now in this COVID time, just to make it really clear, a lot of companies need to focus on pivoting and adapting to their customer needs. And that's what we will learn today, is how can you get to that stage, is building a great product, which would hence get you scale and growth. So you can actually then raise money from early stage investors or even growth stage investors. One of the most important things to keep it simple is this is the foundational framework that has worked for me. And what this actually does is helps you extract the value for your product, understand why does your customer need the product, and how can your company can benefit, right? In the end of the day, there's no such thing as free lunch, because you as a company need to survive. The freemium models can only last you so much. You can only raise so much of VC money. You want to build a sustainable business. That's what we want to focus on. So with this whole so what, who cares, and what's in it for me, if you realize the framework is all about what problem are you solving for your customer? Is it making it easier for them to order groceries? Is it making it easier for them to go to the hospital by a self-driving car? What is it that you're solving? And what value are you providing? Do they even care about it? Are they even meaningful product inventions that you're focusing on as an entrepreneur or as a company that anyone cares about it? Because if you're building a cool technology, but is only valued by you, not useful for anyone, it will never be a successful company. And we have seen many of those. Remember, in the Bay Area, there are more graveyards of startups than more successes, and that's a fact. But this framework would actually help you understand, because once you're able to extract the value of the customer, that you're building a tool that they really need, it's solving their problem. In this case, it could be anything, whether it's ordering an app, ordering a food from your app, whether it's talking to your loved ones in a private ecosystem, or whatever it is. It has to provide an immediate value to your customer. And if it does not, it won't help. And in the end of this, what you will understand is, and this is what I do in most of my product building phases, I ask the customers, like, what's in it for me? Technically, that is kind of the thing. I ask them, so I built this great product. How much are you willing to pay for it? How much are you willing to pay for the service? The answer lies there. And interestingly, you will extract so much value as a product owner in this case is, A, you're able to put a pricing point easily for your product so you can, A, sustain your company, see the value that you're providing, and able to decipher how can you even grow it. Let me give you a real example. When I built my previous company, One Avenue, the product was basically helping Instagrammers and YouTubers to monetize and grow their fan base. And so if I put that in so what, whose problem it was? It wasn't a problem. That's what I learned. But I built it, and then I was like, oh, it's weird. I didn't follow my own rule. But then I started validating as we build it, because we get a lot of users using it. And that's the fallacy that happens sometimes. But I want to understand, are we even building towards a problem that we can, cater more? Like having a good connection for an Instagrammer and a YouTuber with a fan, is it worth it? So we actually went out, conducted around 50 interviews with influencers on Instagram, YouTubers, and they were like one of the top ones as well. And what we realized is it is a big problem for them. So it was a really big problem because it's really hard for them to get above the noise in the social media. And they wanted their own app or their ecosystem basically to connect with their fans. And so they cared about it. And it was a problem for them. And then we want to understand who really cares from that perspective. I know the influencers really care. So what we also extracted was their fans really care. There are some really Gen Z focused youngsters out there who really care, and they idolize these people. They even have, as they call their armies, fan armies. And what's in it for the company and what's in it for them? For them, it was a value that we understood is that they love this idea, they love this product because they're able to extract value from their fans, give them content that they care about the most, first scene content, private content. In return, them as an influencer can grow their fan base, can go advertise new products that they come out with, sell their merchandises, move more items. And as for our company, we were the intersection for them. This framework really helped my company grow to 0 to 6 million users. And the influencers that we got were amazing. We got all the way people from Rock Nation, which is actually owned by Jay-Z. So we got Grimes, we got, they have like a bunch of artists, I don't even remember now. So we got all of them. We got one of the top Instagrammers, influencers as well, and YouTubers too. And it grew. We even had Miranda Lambert signed up to our thing. So the thing is, this framework would help you understand your problem and cater towards your customer. Building a scalable business. And one metric I want to highlight, this allowed us to grow to 100,000 users within the first 6 months. Now, the second thing is actionable research. Something I've seen a lot of even product and entrepreneurs get this wrong is they extract good information, but they're not able to act upon it. And one of the things that I have seen and experienced myself, there would be a case that you would do let's say, conduct a product experimentation with a new product that's coming out. It's in a beta version, and you would do that. So in this case, in Peerless, when I was there working as their product lead, we did this new product rollout where people can upload their blogs. And Peerless is basically a LinkedIn for information security. What we did wrong then, and this is from my own learning, is basically we released this early product, which would allow them to post new blog posts, their news, basically rant about something that they really strongly believe about in the InfoSec community. And interestingly, what we saw was people were like, we want to do this experiment, and people are using it, but we didn't take any further action upon it. And what happens is, the product was being used. We got around, I believe when a test group was up to 1,000. So we got like good, I don't know the numbers, but it was more than 50% of those users were able to use it and they loved it. Here was the big problem, which was not actionable research. We were not able to grow it the way we expected. We thought people would love to create content, share their content, and talk more about it. The problem in that whole product experimentation was the research that we gathered was that rest of the 30-40% that didn't use the product, like basically posting new content, why they didn't do that? We were so focused on this 60% or greater than 50% who actually used it. And this hence caused a problem, because when we released the product, it got a bit of like the growth wasn't as much as we expected, and it actually remained flat. So one of the things I call now is you want to have actionable research. You want to see both sides of the coin. You want to conduct both experimentation, like A/B testing and AA testing, is all those small experimentations and even bigger experimentation that matter. And it's not about quantity. Remember, it's all about quality. And that's one of the examples that I gave you, that, oh, we saw, oh, there are greater number of people using a product, amazing. But the quality matter, because your sample size of whatever you test out, whatever you extract in the early stages of building a product, of building a company, matters more on the quality, not on the quantity. Remember, it's the niche users that actually would help you build your product then, instead of a quantity of users. Yeah, those days of when you had Facebook and Snapchat the way they grew, great, but the landscape have changed a lot. And so it's all about qualitative data. So whenever you as an entrepreneur, you as a product owner are building your product, have a decent sample size, but focus and double down on both sides of the coin to have a better understanding, which can give you a better picture of what A, you're lacking, what can you improve, and B, what's working and what can you take from the working part and help it for the people who do not like that feature that you rolled out, a product that you rolled out. One of the other things is also smart approach. And this is really commonly I practice with all the entrepreneurs and advisors, anyone I'm advising at this moment, is being really specific, measured, attainable, relevant, and time-based. Right now, I'm helping this project called One World Love, and we're building this platform for basically COVID relief. And we got like 6, 7 people who joined the team. All of them come from a really big, fantastic background, rock star backgrounds, and I must say. Problem. A lot of people have many ideas. A lot of people think certain features important. And it's really important when you get a lot of feedback, a lot of features, a lot of requests, you as an entrepreneur or as a product owner want to be like, how is this feature, this request that I'm getting is helping me direct to my goal? Is it making it larger or is it making me focused? And the way you realize is by building having a good idea of your MVP. And that's when I talked about the early research that you do, talk to your customers, understand who you're building it for. Once you have that, that would actually be a great framework for you to move forward and to be more specific as you build. And as you build, you want to make sure you're able to have the metrics, be able to have accountability of, is this successful or is this a failure or is there room for improvement? And from there, it's all downhill, because once you know if you're specific, you know what you're measuring, it becomes easy to know if there's any other resources that you want to build or any tool that you're building, is it attainable, not attainable? And trust me, I've come across companies, actually in the past year, 4 companies that I was helping, and their biggest problem was that A, they were not specific, so that cost them the money, so they actually had a lot of burn rate in that case. Whatever they decided to build, it wasn't attainable. They would give the guidelines to their investors, is like, oh, we have this in this quarter, we're gonna build this great, amazing feature in this quarter, and the reality would be it would take them 5 months. And I was helping them, guiding them. No, it's not possible. You have to roll back. You have to be more specific. This is too large. This is too large. And I understand as an entrepreneur, you're more protective. It's your baby and you want to push forward. But I will recommend and request you to break it down in this framework when you're building a product. Remember, the goal of your company, of your end goal, is basically to build a profitable business. And first and foremost, mostly is basically building an impactful product for your customer. Whatever you're building helps you achieve that, great. If it doesn't, move on to the next. And it's a hard line, but that's the reality when it hits. And it's really important for you to understand this. This is something I would suggest is the whole, if you realize the amount of time I've mentioned users and customer feedback is important. And even if you're an early stage startup, or if you've read the book, actually, Lean Startup, that actually will tell you the same thing, what I'm sharing right now, is validate your ideas. Make sure you get feedback. Make sure you have a loop. And this is the lean approach. With every step of your product that you're building, whether it's from an idea stage to a rough, good sketch place of your product, to a high fidelity prototype of your product, each of those steps and those phases are really important for you as an entrepreneur, as a product owner, because if you will not go focus on the users there, you will not do user testing there, you will fail. And we have seen that multiple times. And that's what even I have seen. There were times when I founded my first company, which was a search engine that allows you to basically see recommendations based on what people are recommending on social media. So I would get the Facebook data and Twitter data, and I would actually rank them. But I would rank them differently. Basically, my ranking method was that let me rank them based on the popularity. So it's like more backlinks, right? And so I built that product out. People had mixed reaction to my product when I launched it, released it in certain forums. And one of the biggest thing that helped me after when I started becoming more user feedback oriented is they start saying, Imran, your product is great, but how is it any different than Google? You're ranking the same way the way Google does. I'd rather go to Google. You know what would be great? That if you could rank the results based on social recommendation, that would be interesting. And guess what? That wasn't one user telling me that. That was across all of them. And I was realizing, why is our metric going down? Like, you can see recommendation, you can search anything, there's not even filters needed. That was the key. That there was the key to make it easier for people to see that what people are recommending online on social media. That thing helped me grow. And that way, the only way I was able to grow it is because the feedback loop that I then started using from my users, start actually getting feedback from around 1,000 users a week. And that was amazing because I incorporated a lot of tools that they can actually send me feedback. And so in this whole process, that's what I'm trying to mention. No matter where you are in your process, whether you haven't or have, it is never too late to get a user feedback. You may never know. There are companies like Yelp who have done it. There are companies like Slack, Uber, who have done the same thing. They would start off and they would think it's a need. Then they realize, oops, it's not a need. Guess what? We're in the wrong market. But whatever helped them to become successful today is incorporating their customer first. One of the last points in all of this is data, I call it. And it's super simple if you see from the beginning to the end what I'm talking about is your customers first. But not always talking to your customer will help you, right? That's only one data point that you can extract. What's the other data points that you can extract is the usage of your app, is seeing the metrics that are being used, seeing how customers are using your app. That could be Google Analytics, Mixpanel, so forth. Conducting user interviews. And also I would recommend seeing external benchmarks. You can extract it from multiple websites, how certain websites are used, how they're built, how they grew, and how you're doing. So you need to have that some kind of a benchmark that you can compare yourself with. SurveyMonkey does have one if you're doing one customer interviews to that. So that's a good one. But in all of this, what's really important is focusing and capturing your user and your customer needs everywhere. And as funny as it may sound that, oh, it's how is this useful for growing the company, or, you know, I know a lot of entrepreneurs who say, no, but we're building a great product. Trust me, if you don't have your customer in your center of your attention, you can never outgrow, you can never grow, you can never be $1 billion company. And that's a fact. One of my last things I want to say is I want to end it with a quote, which is really good. I like, is stay focused on your customers. We often, including myself and including other entrepreneurs I've seen, they always end up focusing on their competitors, which is not a bad thing. It's okay. Focus on what they're doing. Be careful. Watch your guards. See if you're, being interfered in the market or how's it going. But if you build a customer first experience from design to product to onboarding to making easy for them to, give them more value, I will guarantee you this, that your product will always be number one. And with that note, I want to say that Slack has proven out to be that. Slack came in a time where you already had HipChat from Atlassian that everybody was using. There were other chat apps too. The reason why Slack took off is not because, oh, it's a chat app, but their focus was easy, and the design and the product was all customer, all user focused in workplaces. But that ends, this ends my presentation. Feel free to reach out. I'm always willing to help, mentor, and advise companies. And now I would like to hand it over to you, Nadia.
Thank you so much, Imran, and thank you, everybody. We thank all our participants today for their keynotes, and we invite you to our next events tomorrow, also with a number of roadshows from Singapore and internationally. So please join us for masterclasses, Startup Leaders Club, and roadshows with pitch competitions. See you. Bye-bye.